much better position, I would say, partly by luck and partly by design and policy. Luck being the collapse in commodity prices, particularly oil prices, and the policy aspect being primarily macro. Right? I think the Reserve Bank has done, under Rajan, has done an amazing job in turning everything around. You know, if we roll back the tape to 2.5 years ago during the taper tantrum, India was the most fragile of the fragile five, and today it's probably the most improved, right? Like you said, it's an oasis, an island of stability, a continent of stability, in a world where a lot is going wrong. So I think that's an amazing change. I think the key is to keep that macro improvement in train and to do whatever can be done politically and otherwise on the reform front to raise the potential growth rate in a sustainable fashion.
Okay, and I'm going to get to reforms in a moment because I think that's an issue which everyone will have something to say on. But Prashant, I want to bring you in here on also what global risks still remain, despite the fact that we have all these advantages, despite the fact that we are seeing liquidity move in that direction or look at India as an attractive investment option. What are some of the risks to that, given what we're watching out for from the Fed, for example, or from other global events over the next few months?
We can't wish away the global risk, right?
Yeah.
I mean, in this interconnected world, obviously we'll have risk which will arise from, let's say, whatever Fed does on the interest rate, whatever happens in China in terms of whether their growth slows down and by how much, what happens to the commodity prices, because that's again linked to the global demand-supply situation, nothing which India can influence. So I think the global factors would continue to play a role in terms of how the Indian story really develops and evolves further. For example, you are seeing that as of now, the exports in India are contracting, and they're contracting massively by about 20% or so. And the primary reason is that, one, the commodity prices are cooling off, and secondly, you're not seeing much demand for the Indian products in the economies which are slowing down globally. So I think we'll need to live with this situation, and we'll need to accept that these are not the days of 2004, 2007, when every country in the world was doing very well, and therefore you could grow at whatever rate you wanted to. You will be constrained somewhere by whatever happens in the rest of the world. Right.
Craig, according to you as well, how does India stack up right now amongst the other emerging markets?
So I think the problem for India is that maybe measured against the history of its own story, it doesn't look as great now as it did, say, a year ago when people were very euphoric. But I think, as you're implying, the relative value within emerging markets is still very high. It still gives you more hope than a lot of other EMs. So the demographic situation is very strong, one of the strongest in EM, provided it can be utilized, which isn't a done deal. The reform front, although we have had disappointments compared to expectations, at least there is something of a blueprint for reforms. There is a policy desire and will to push them through. In other economies, we haven't really seen that. There's no real roadmap in Brazil, for moving away from commodities. Ditto Russia, Indonesia, Turkey, South Africa. It's all everywhere. They need to start reforms, but they haven't even got an idea yet of what they need to do. So I think in India, even though they are going to have political problems pushing through the reforms, you can at least take confidence from the fact that they want to get some done at all.
Right. Right. So would you agree, Ankit, and do you see a further shift in allocation to the region?
India has been already attracting a lot of flows this year, but on a reform side, yes, as mentioned earlier, India has been quite lucky over the last few months because commodity prices all of a sudden has gone down. That has helped Indian economy massively. And the changes that we are seeing are slow and also helping investor sentiment. We need to see more of these changes, more of the structural changes happening faster for India to sustainably attract flows. In the short term, there are risks. So for example, if there's a big downturn in the global economy, India will suffer. And when there's a big outflows from emerging market as a whole, people will not just save their Indian portfolio and sell everything else, they'll sell everything together. So India is not isolated from a big global economic risk.
And what is the chance of that risk? That, the most immediate one being, of course, the Fed rate hike. What is the kind of impact you see of that?
So what we have seen over the last few weeks, we have seen dollar rally massively in anticipation for a Fed rate hike. So what it means is, China, as a trade-weighted currency, renminbi is also appreciating massively at the same point. We saw China accepting this move in the FX rate for the whole of first 3 quarters this year. Then all of a sudden they went with a shock move in the FX market. And currently China is again faced with the same situation where on a trade weighted basis, the currency has appreciated massively. So if all of a sudden we see Chinese central bank not able to take the pressure anymore and we see a sudden shock in the market, that can mean a big deflationary shock for the whole world. And we could have another few months of bad commodity prices, weak emerging market in general.
Okay, so in that context, Arnab, I want to come back to the internals and whether or not you feel that the domestic story is strong enough to withstand some of those external shocks.
Well, I think India has, I guess, some of the benefits of being a relatively large, relatively closed economy that is mainly about domestic demand. And I take the point, there is a global constraint to growth even in India, but compared to most other emerging market countries, particularly the large ones where at least the equity market is relatively liquid, the currency market is relatively liquid, even if the bond market is constrained, it's a country where you can do a lot of things to take advantage of or to invest in the process of domestic demand-led growth. So I think that the conditions are better, subject to the caveat, I think that this commitment to reform continues to be delivered, right? I think that's the biggest issue, that this growth boom that we've had in the last couple of decades in emerging markets, everyone is fond of saying, oh, the potential growth rate in EM is much higher than in DM. Well, maybe so. Maybe this time really is different, but that's not the history, right? The history of emerging markets, to some extent including India, is boom and bust cycles. To get out of that, right, a lot has to change. In particular, what has to change is a much better much better approach to macroeconomic management, which seems to be taking place, and a much more flexible real economy through structural reform. It's not enough to just say so. I think it has to be delivered, right? And that's really the critical test to keep this domestic demand story going for the long run and for India to realize its potential, which is clearly enormous.
In terms of sentiment, particularly post, for instance, some of the high-profile events, the foreign visits by the Prime Minister, has that been enough? Do you feel investor optimism is still at its peak, or has it faded somewhat while it awaits execution?
I'm not sure that the optimism has faded, but I think there is a kind of a latent concern. We've had all of these repeated campaigns, both for election by this government and since, and even before, under the previous government, India shining, incredible India, and now make in India. And I think it's very important to have these slogans, but it's important to go beyond the slogan, right? To actually, like I said, to actually deliver. And if we keep talking and not doing, at some point people are going to lose patience.
What do you think, Craig? Or do you also feel that investors are now keenly watching in terms of the execution agenda? We've heard a lot of big talk in terms of what really is on the priority list, how the government's aware of what investors are watching out for and looking for. Are you keenly watching execution, or is intent enough for now?
I think execution is basically all that matters now. The intent has been there for a long time, as Arnab said. I think you really have to see some actual progress on the ground, and that's clearly what corporates are waiting for as well. If you look at loan demand by corporates in India from the private banks who actually still have some money left to lend out, that's very weak. Investment plans generally very low. A lot of the growth now in India is coming from the consumer side. Corporates are going to hold back until they see a concrete commitment, not a six-month sort of statutory extension of some law. They need it to be on the books permanently, and that's some way off.
So give us a sense of a timeline. What would investors be looking for? Because the new government has had just about, let's say, just 18 months or a little under 2 years to really outline its agenda. When we're talking about wanting to see execution, when does the patience run out?
Well, I suppose it depends on whether you want to look at international or domestic investors. On the domestic side, I guess they just have to wait as long as it takes, because there's nowhere else to go. On the international side, as long as India is relatively better than the rest of EM, then it's okay. So I think the rest of EM, the big markets at least, they'll be struggling for a while. So Brazil's got a couple of years of quite painful adjustments to make. Russia won't be growing very quickly anytime soon. China's on a gradual slow downward trend. So I think you do have a couple of years for the rest of EM stocks being a very attractive alternative, and for the rest of EM stocks to make their own reform promises, which seem credible.
Right.
But after that 2 years, that's when the money starts to really, at the very latest, that's when it all starts to flood out.
Okay, so what is the kind of growth outlook, let's say, for the next couple of years? What is the kind of potential that you see, given some of the factors at play currently?
It is actually very difficult to really put it in numbers. I mean, given the way the GDP growth calculations have changed in India, I don't know what 7.5% growth today means.
Right.
Because when I look at what 7.5% growth used to be in terms of car sales, or used to be in terms of the different consumer categories, or in terms of the industrial capex, now 7.5% feels very different. And therefore, I don't really know what rate India is growing at today. And therefore, it's very difficult to make a guess on what will happen few years down the line. But surely, looking bottom up, when we look at different companies in terms of what they're achieving, surely there is a way for them to move ahead, move upwards in terms of their growth rates. There are companies who actually decelerated over the last 1 year, which is probably telling us that the economy is actually slowing down even after the new government has come in. And you can blame it on rural slowdown, you can blame it on global growth slowing down, or you can just blame it on maybe the tight policies which this government as well as the RBI is running. But I think the overall impact is that the economy is kind of slowing down. And therefore, we actually first need to get back to the levels at which it was maybe a year back, and then think of accelerating it further.
So what do you think needs to be done for the investment cycle to pick up, to get things going again? Government spending has picked up, of course, but as we've just discussed, we haven't seen that pick up on the private side. What do you feel could be the necessary trigger?
I think the steps that the government is taking are in the right direction. I mean, all these things about improving the ease of doing business in India and facilitating the Make in India kind of programs are obviously helpful. What we actually need to see is that, as he said, that it has to be executed well on the ground. So still there is a big disconnect between what there's an intention at the PMO level and what we really see at the ground level. And maybe it's also a question of bandwidth out there. I mean, there are programs out there in India where we are seeing very fast progress. For example, the coal production of India has gone up a lot. For example, there's a big progress in terms of the TFC project in India. But there are also certain programs or certain areas which are just getting neglected, maybe because there's not enough bandwidth in that system out there. So I think somewhere the government needs to probably bring in more expertise from outside in its system, so that more areas can be tackled at once.
Okay. How critical do you feel reforms such as GST, land acquisition, in order to get some of this going, and in terms of also bringing in the capital flows? Land acquisition, in fact, almost on the back burner for now. But GST, there's still a strong push to see that happen at least early next year. How critical do you feel a reform of that kind could be?
I think if there's one single kind of front burner, symbolic and actual reform that could make a very big difference, I would say that's GST. Right? There are a lot of studies that show, academic studies that show that trade liberalization is the best reform for raising potential growth in the long run. And GST and associated changes are equivalent to trade liberalization, right? Because obviously there are a lot of barriers to economic exchange between the states of the Indian Union. And in a world which is growing slowly, where external constraints are being imposed because global trade growth is slowing down, this could make a huge difference like I say, in raising the potential growth rate in India. And I think it would generate an enormous response in domestic and foreign direct investment, in equity risk premia, in bond yields, in the currency, in everything. So, you don't want to hang everything on one thing, but if there were one, sort of change that would make a huge difference in perception, that would be it.
Have the recent reforms, for instance, on FDI across sectors, have some of these things also helped? We've been speaking to a few investors who seem to call it a knee-jerk reaction ahead of the Prime Minister's visit and post the state elections. So how did you view some of those reforms and the timing?
Well, I think progress is always good, almost, cynically speaking, regardless of the cause. So maybe he should make more of these state visits, and maybe more would get done. But seriously, I think there's like Craig said, there is a design, right, and a plan, and many countries have plans, and some countries don't. Turkey has a plan with, I think, 1,380 planned structural reforms, right, which is like saying you don't have a plan at all because there's just this overwhelming mass that you may or may not get through. So I think a plan is very good. And to have fallbacks and to do things that can be done because of the complexities, even if there aren't ideological objections, which is often the case, right? It's really about who gets to say yes and who gets to say no. To be able to figure out how to progress, I think people will respond to that as well.
Okay. In terms of the balance between growth and inflation and the RBI's role here, Prashant, I just want to get your views on that as well. I mean, a bit of a pre-Diwali bonanza that we got from the central bank, but how much more do you feel they could do at this point? And do you feel that the shift towards growth has been pronounced enough?
RBI has surely been an inflation hawk, I mean, under the regime of Mr. Rajan. And maybe it was also partly responsible for this slowdown in the economy that we are seeing. But I think this is kind of the right medicine for the longer term. So you're really reining in inflation at the levels at which you want to be for the next 5-10 years. And once you bring that inflation down to those levels and let it just then go, then I think you can actually have good impact on the economy because suddenly consumers are not worried about, okay, this item will become 10%, 20% more expensive next year. I mean, you're really thinking about a low level of inflation, which is actually good for investment as well as savings out there. I mean, what you really saw in last 5 years was that because of this high inflation, people rather than putting their money in deposits, they were just putting their money in gold and real estate. I mean, obviously, that's kind of a wasteful allocation, and India is not really bountiful in terms of capital. You really need to channelize those savings in more productive assets, and which is what probably would happen once the interest rates come down, and therefore you can see that better use of that money is probably to put in more productive things like maybe equities.
Okay, so in terms of themes, Ankit, let me come to you on this. In terms of themes that could possibly play out going forward from here, given the context and scenario that we've just discussed, what would be on your radar?
On our radar, we continue to see manufacturing sector slow down. So as I explained, the risk about China is going to last for a while. It's not going to go away all of a sudden. So manufacturing sector is likely to be under pressure. So all the high capital intensive sectors as a result, and even in India, will be under pressure. One good thing about EM, even in a scenario of an EM slowdown, consumers are still doing well. So consumers still, especially in India, have a huge amount of spending capacity, and this is very much reflected by the consumer exposed stocks in India. For example, if you look at any half decent consumer exposed stock, it's trading at a PE of about 20, which from developed market standards is very high, because they are betting on strength of consumer sector. They are betting on continuing growth of the consumer sector, consuming spending power. So be long consumer is a good theme, and be careful on the high capital intensive manufacturing related sectors. Even though in India we know we have seeing rise in capex opportunities, but like not at a very rapid pace. Nothing that can pose a significant risk to this view in mind.
Okay. In terms of themes that you're watching out for as well, Craig, and I also want to put it, in the context of valuations, because we've seen, a lot of these companies actually run up extensively last year, as we were talking about earlier, and given the sort of stagnant stage that we're seeing in terms of capex at this point, do you really see value in investing at this particular point of time, or would you wait a bit?
So I don't deal in equities specifically, so it's a tricky one for me to answer. I guess just from a purely macro perspective, I think a lot of things have been priced in terms of, the market rallied hugely on the assumption that it seemed to me at the start that Modi was going to achieve every single goal he'd listed, and he was going to do it all in 100 days. So it was a brilliant time to invest if you believe that. Obviously, that hasn't happened, and the market has corrected a little bit, but really it's still at those same levels. So it's still pricing in a very high number, a very high degree of success on the reform front. So to me, until you actually get, again, this execution materializing, I'd say the valuations maybe would be fair based on the macro view. But obviously, as we've seen in the Chinese equity market, it's often sentiment that drives things more than macro factors. So who knows? As
is the case across equities. What do you think, Arnab? What do you feel? Is this the right time to get in? If we're watching out for huge booster growth in a couple of years, or would you still wait a bit for perhaps a bit of cooling off?
I think I think you on the equity front probably wait a little bit. I think my observation is that with constraints that have been gradually liberalized, but still fairly binding in the bond market, the desired foreign exposure to India gets shifted into the equity market and makes the equity market perennially expensive relative to other countries, and relative to other countries' equities versus their bonds, right? So I think on that basis, if there's more liberalization to come in the bond market, which shows signs of being the case, and more reform beyond commitment, then there are probably going to be better opportunities to get in later into the equity market from a domestic standpoint. And then if we look around the world, as you just said, China is a bit of a has a bit of a challenge here, right? Being pegged to the dollar indirectly managed float with the Fed about to tighten, and with the clear risk being that the Fed does maybe more than is now priced in rather than less. I think most people are expecting a very attenuated kind of Fed tightening cycle. The risk is that it's stronger than expected, and that tightens financial conditions, not just in the United States, but in China and emerging markets, and causes some more collateral damage. That also suggests to me that caution is the better part of discretion, or whatever the saying is. Right.
Fair enough. Cautious optimism, perhaps, is the consensus. Arnab, any particular themes that you're going to be focusing on or eyeing closely?
Well, I think if I can take a bit of an unorthodox approach to this question, I would say, India should get rid of its China envy. Right? I think,
That's funny, because the next question was going to be, are we still better off than China or not?
Okay. All right. Well, I'll prepone the answer. I think, running a country to achieve a growth rate that has been achieved possibly with unsustainable imbalances by a rival or whatever is absolutely the wrong way to run a country, particularly if it's 1.3 billion people, right? It's a big mistake. You should run it according to what it can achieve on its own merits. And I think that's what Rajan brings to the table. And it's not obvious to me that the rest of the structure of the state in India has bought into that. So we're making up the numbers now, too. So that's a bit of a challenge, I would say.
Okay. I want to come back to the China envy bit, Craig, because I'm sure you see a lot of it in your interactions as well. But I think there's also an element of fear attached at the moment, given the kind of volatility we've seen in China over the last few months, and how that could impact investor sentiment for the emerging market basket as a whole.
So that's a good, I suppose the big fear which we saw in the summer, actually, when the Chinese equity market was crashing, everyone assumed that meant the Chinese economy was crashing. It turned out that wasn't the case. But as soon as that fear was there, everything sold off. But I think particularly on the commodity side. So there will be particularly big losers in the case of a China hard landing or just a more pronounced slowdown than we're seeing at the moment. I think in that context, India actually is quite well positioned because it's not really reliant on China as a trade partner. It obviously imports the commodities that will become cheaper in the case of a Chinese collapse. It would be hurt to an extent by EM contagion risk and so on. But again, at the moment, the Indian bond market is not particularly accessible to outsiders. So it's not as though, I wouldn't expect borrowing costs to suddenly shoot up because foreign capital is leaving, because there's very little there to begin with. So in that scenario, actually, India is, again, relatively well positioned within emerging markets, but EM as a whole would be very badly hit.
All right. On that note, I'm going to thank you all very much for joining us today with all of those insightful comments on the way forward for Indian markets. They're definitely going to keep us on our toes. And I'd like to also hand over to Siddharth Sarabi and Manoj Ladwa to also greet the ministers that are joining us this evening. Thank you so much.
Thank you.